The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, happy Saturday. This is Esther Gulius, the tax lady from EG Tax, and we love joining you every Saturday from 3 to 4 to give you some pointers as we march in out of 2019 into 2020 when the jig is up. So that's our whole thing, to keep you guys up to date on what's happening, and as they change the tax laws or reviewing things that are timely, we want to make sure that you have to pay the least amount of taxes, get the largest refund, and how to kind of facilitate that as your year goes on. And of course, I'm joined in studio again with Tiffany Fabian. Hey, Tiff.
Hey there, Esther. Happy Saturday.
Happy Saturday. And Christopher Fabian.
Hello, Esther.
Hello, Christopher. So I heard you flunked your 23andMe test, right?
Yeah, no DNA in my system.
Busted.
Can you imagine? You had bad spit,
I had bad spit. What can I say?
and they made you send it back.
You're sending me a new kit.
Okay.
Maybe
I know
I'll
you're
throw in my
you're gonna
dogs
find
and
out
see
that
what
you're
happens.
A Russian. That's the way it goes. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Our text number is 3930. And of course, if you're getting love letters, you still haven't gotten your refund, whatever, you can give us a call. We're happy to help you. We do have a subject today. We're talking about getting ready for school. And on that subject, our school is going to start, right, Tim?
Yep. October 10th, our usual annual tax school where you learn taxes from A to Z. It meets twice a week in the mornings or evenings, whatever is more convenient for you. There's also an online version. If that is more convenient, it's free of charge. You do, however, have to purchase the book and the software, or you could just do it all electronically, which is even half the cost. And the intent is that we would love you to work at any of our 31 offices. We just actually had a new office in Orchard Park, and so that's a new office.
Yeah, that's
so
really
very
exciting. We have a brand new Orchard Park office.
Yep,
and of
on
course,
North Buffalo.
taxes are so confusing and complicated. Our first year people pretty much come in as novices, and they're learning the business. And we really take you on a 4-year journey where we will help you to get your enrolled agent status, which would be the equivalent of like a CPA and taxes, and there's no charge. I mean, we just do this because we want our people to be the best that they possibly can be. So that's why we are always training and retraining our staff, and with the goal of them becoming enrolled agents, and so that's what we do, right? So if they want to join our school and stay off the roads during the winter, right? How would they do that?
Sure, you can go to egtax.com and you can register, or you can call 632-7886 on Monday, and we could register you over the phone, or we can email you the registration form. But probably the easiest way is just to go to egtax.com and click on Learn About School, and then all the information you need is right there at your fingertips.
Right, and again, you can come to school, or you can stay home and learn online. So it makes it really, really convenient.
Right. If
So-
you're, and I want to say, if, you're a do-it-yourselfer, or maybe you worked for somebody else in the past, we love to have experienced people come into. We do have, like Esther was saying, those advanced classes. We can throw you in there and help you with our software, so it's just not for novices. This is for everybody.
Right. Okay, so let's talk about, this is really an important subject because it's a lot of money, and probably it's one of the most confusing areas because it's so common. Sometimes people will say, "Oh, well, what you're talking about, this doesn't affect me," but probably if this doesn't affect you, it will affect you, and if it hasn't affected you yet, it might affect your kids or grandkids. It's all about the cost of education and all the education credits and things you should watch out as you have your kids going to school. So that's the subject that we have today. And again, you can call us 8030930, start 930 on a cell phone. 3930 is our text number, and you can talk about these school-related issues and credits, or you can talk to us about anything that's happening in your tax world. Remember, we just have September, October, November, December, 4 months to facilitate some positive changes on your 2019 return. And again, they're also talking about tax cuts 2.0 with the Trump administration, and if that comes down the pike, we'll explain all that too. But the first thing we have on our little list here is when a kid is claimed, when a child is over the age of 19 and under the age of 24 and a full-time student, then who would be able to, this would be the qualifying individual of who?
That would be mom and dad.
Right.
Under the age of 24, you can claim your
Right,
kids.
and let's
as
say
long as they're in
Junior's
school.
making $4,000 working at the grocery store as a bagger or something. Does he have to file a return?
No. Well, he's
Doesn't
close
have to,
from New
right?
York.
Well, right. I mean, you don't have to, but if there's withholding, he would want to.
That's
And the
exactly right.
income does not go on the parent's return.
That's correct. So here's the first thing we wanted to make sure. If you have a kid that's working and they are your qualified dependent, okay? Even though they made less than $12,000 on the federal, they aren't required to file a return, but they want to file a return because they have a refund coming for their withholding. And what I have seen is sometimes parents might have 2 and 3 years returns, W-2s sitting in their file cabinet at home, and they haven't filed them. And that's money that is just sitting at the Treasury Department and sometimes on New York State as well, because you just haven't filed the return. The first thing we want you to know is file those returns, even if the kid doesn't have to file.
Yeah, one of my clients, I've been doing their return for years and years and years, and their adult daughter is disabled, and she has a job that she works for a disabled person, and she gets a W-2, and they were just stuffing her W-2s into a drawer. And I said, bring them in, and there was hundreds of dollars on the table, because actually they don't claim her either. So it was really a nice windfall.
So anybody that makes less than $12,000, if they're single, and you don't have to file, whether you're claimed on your mom and dad's return or not, you have withholding, you're going to get the money back. Now, if you are claiming on mom and dad's return, there's kind of a caveat on New York State. What would that be, Chris?
Your standard deduction is only $3,000. So the odds are, if you made $8,000, even though you don't have to pay file the federal, you have to file New York State.
Because you're going to owe money.
Because you're probably going to owe money,
Right.
yes.
So, but usually the federal way outweighs New York State. And the other thing that's good is the kid then gets a heads up on changing their withholding.
That's right.
Right, because you want to make sure, even though you're making less than $12,000 and you don't have to file, you can change your withholding on the federal and New York State, and New York State probably you'd have more withheld.
Yeah,
Right?
absolutely. Because otherwise, kids are always short on New York State, and they always end up owing when they're claimed as a dependent. And so you want to alter that situation.
Right. Now, what happens when kids are in college? They're sitting in their dorm room, and all the kids are saying, don't let your parents claim that credit. You claim yourself. So the kid then sits down at the computer if they're doing their own return, and they knock off a tax return, and they claim themselves as the dependent, and then the parents claim the kid as well. What happens in that situation when both entities claim themselves?
The first person in gets the exemption. So if it was the child who did it at the end of January, mom and dad are going to have to send in a paper return and amend the kid's return, and the child's going to have to pay back all that money.
That's right. So before, have this conversation, while you guys are having Christmas dinner or New Year's breakfast or whatever, say, okay, Junior, do not do your tax return as soon as they come in until you talk to mom and dad, because we're going to claim you and you should not. So when Junior does his return, he puts that he's being claimed by someone else.
Right.
So when you're a do-it-yourselfer, you don't know. right? The computer asks the question, you think the logical answer, and that's it. But unfortunately, in this situation, the kid's return affects the parents,
Correct.
right?
Big time.
All right. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. I know we got calls coming in. We're going to take a short break, and we'll be back and talk to these people that have called in.
We are family. I got all my sisters with me.
Hey, that's our new theme song, We Are Family, because to you, we just want to help you. To us, we are family. We think of you as family. And so if you have any questions, you can give us a call, 8030930, 8030930, star 930 on your cell phone. And that little tip that we just gave in the last segment about kids doing their filing their tax returns, if you're sitting home with those W-2s in the file cabinet drawer, get those returns filed, and actually after 3 years, you lose the refunds, right?
Yep.
Yep,
Okay,
statute of
and
limitations.
let's go to the phones, and we have Denise first, right?
Yep.
Hey, Denise, how can we help you?
Hi, I have a question about a grandparent owns a 529 plan. So he wants to distribute the money to pay for the room and board for college.
Okay,
The question is that taxable to the students then because the grandparent owns it?
right, Chris?
No, it's not. As long as that money and the child is the beneficiary, that is not a taxable transaction to either party
As long as
involved.
it's for qualified education, and that'll qualify. So he just takes the distribution, gives it for the room and board, and they'll be good to go.
Okay, I thought it was taxable unless it was owned by the student or the parent.
No.
Okay. And then can they claim any credits for that if it's
No.
the 529? No. Okay.
No, they would have taken the 529 deduction when they put it in.
But they do still get
the federal.
the federal credit.
No, the grant. Are you talking about the grandparents getting the credit,
No,
or
the
the kid?
parents, the kids, the parents.
Are you talking about the grandparents?
The
getting
parents would get the credit for the education on the federal, not New
right,
York State.
Right. I thought she meant does the grandparents get the credit?
Of course
No, the
not.
grandparents get nothing. They took the deduction when they put it in. But yes, if and especially if it's paying for room and board, then the education is still going to be deductible unless they're on a full scholarship, right?
Right.
They'll
That's
get the
right.
credit.
Does
Okay.
that answer that question for you?
Yeah.
Denise?
Thank you.
You're
Thanks,
welcome.
Denise. Okay, and then we're going to go to Kevin. Hey, Kevin, how can we help you?
Yeah, good evening, folks. Esther, welcome back. Hey, a question relating to your 401k. If you dip into that, what do they have a set percentage penalty that you pay, or it depends on the amount that you take out? And the reason why I was asking, I was considering dipping into it for life-impacting or life-changing situation a couple of weeks ago.
Okay, so how old are you, Kev?
I'm over 50, but
You're over 50, or
Are you
you're not
under
59
60?
and a half?
I'm under 60. I'm definitely under 60. Yeah.
You're under 59 and a half, correct?
Yes, sir. Yes, ma'am.
Okay, so there is a set penalty for taking money out of your qualified pension plan or IRA if you're under the age of 59 and a half, unless you have retired, and that's another situation. But if you're still working, there is a penalty of 10%, unless you're not paying for medical bills, are you?
No, it wasn't for medical bills. No.
Okay, and you're not
separated
you're
from your
not
employer?
you're not having you're not unable to work. You haven't been laid off. You aren't unable. You're not disabled for a year or more.
No, actually, it was just to contribute towards some funeral expenses for a relative.
Okay, all right. So the penalty for that is, well, first of all, it's going to be fully taxable at your tax rate, and you're going to have and fully taxable on New York State, and you're going to have a 10% penalty. So you might be wiser off taking a personal loan. I know that the Pentagon Federal Credit Union, I think, is 6% on a personal loan right now. And so when you take a look at maybe if you're in the 15% bracket federal with the 10% penalty, now you're at 25, and the state of New York, maybe another 6%. Now you're at 31%. 6% a personal loan rate would be a much better deal.
Or some 401ks let you take a loan from them too, so you might
Right,
want to
a loan
find
would
out.
be much better than actually taking the money out. That's a good call, Tiff.
Yeah. Well, I already got a loan on it too, so.
Well, then what I'd suggest you do is, have you thought of just putting it on a charge card? Do you have a 0% charge card?
We eventually did that with my other siblings. We just decided just to cut.
Well, now so that's really smart, because instead of paying 31% plus, if you have it on a low interest credit card, that's the best you can do.
Oh,
Another one of my clients, he had a loan on his 401k at his employer, but he only owed like $1,000. And so he paid off that $1,000 loan that he had on his 401k. And then there was room for another $8,000 or $9,000. So sometimes if you can pay off what you owe, there's going to be room for another $9,000 or $10,000. So that's a thought.
Okay.
yeah. Actually, a similar situation as that client you mentioned, but time was of essence.
Okay, gotcha.
Yeah, I know. When it's an emergency like that, especially if you don't see it coming, it can be terrible. But I will tell you, when you think about, it's so convenient because you can go to your employer, take it out. But what you don't realize is you're going to pay 31% on the back end. Now, if you could borrow the money at 6%, that's really 5 years worth of interest that you'd be able to pay at 6% to recoup what you would be paying 1 year to the federal and state. So taking money out of your pension plan is not a good thing.
Okay.
All right? Thanks, Kevin. Thanks for calling. All right, and then we got Bruce, right?
Yep.
Hey, Bruce.
How you doing?
Good, I'm good. What's new?
Well, my wife had two questions on things her mother did for her. 15 years ago, the house that was signed over is in Delaware to begin with, okay? And it was signed over to my wife and her brother 15 years ago with an agreement that her mother would stay there for the rest of her life. And
A life
A
estate,
life estate.
right?
Yes, her mother
Okay.
passed away 2 years ago,
Okay,
and the house is being sold this year.
okay.
Is the proceeds taxable?
All right, so
The entire estate is going to be well under $1 million in value.
okay, so Chris, make her happy.
Sure.
Okay.
Since she
Make him
inherited the property, she'll get the stepped up basis, meaning what the house was worth when mom passed away 2 years ago. So if the house was worth $300,000, you're selling it for $300,000. There is no gain on the tax return, so it would be tax free. But if it was
So
worth three,
So it's going to have to be reported, but because of the stepped-up basis, technically, unless there was a gigantic increase over the last couple of years, there's going to be no taxes due.
Actually, they're paying money right now, probably between $15,000 and $20,000 for repairs before the sale is finalized.
Okay, so that'll all go to the basis, but
And then they
basically, the
could
good news is
potentially have a loss.
you're not going to owe anything, and potentially there might be a loss.
Which is a good tax situation.
Okay. The fact the house was signed over to them 15 years ago.
Well, now, you made it sound like it was a life estate. So you want to double check with the attorney. If it was a life estate where mom had the right to live there, they couldn't sell it out from under her, that they weren't on the deed and title except that there was a life estate in place. If there was a life estate in place, then she gets a stepped-up basis. If she signed over the title
Right.
and the kids had right to do what they want with the house, they could have kicked mom out at any time, that's a horse of a different color, it'd be fully taxable.
Fully
It
taxed.
would be, well, not fully taxable. The difference between what mom paid for the house, did dad pass away recently?
No, prior to this, about 20 years ago.
Okay, so the fair market, half of the fair market value when dad passed away, then what what mom paid for the house originally plus any improvements would be the adjusted basis. So if the title was actually signed over, then you don't get the stepped up basis. If there was a life estate, which it sounded like you were saying,
Right.
then she gets a stepped up basis.
Okay. Okay. And one other question on the same time frame is that mom set up a deferred annuity for my wife, and she's either going to start collecting on the annuity next year or she's going to roll it over. It was worth $20,000 initially, and now it's worth about $34,000. Is that taxable, or is that a gift, or how did?
Well, it all depends. Did mom put after-tax dollars into the annuity?
Out of her own money, yes.
Right. So if it was after-tax dollars, then let's say that you're saying it's worth $34,000 now. Let's say mom put in 20, there's a $14,000 gain, and so that portion of it's going to be taxable.
Okay, and now it was in my wife's name.
Okay, but
You follow me?
are you, so your mother gave your wife the money for the?
Prior to the death?
It's 15 years ago. She gave her. She set up this deferred.
Okay, but it was still after-tax dollars.
Yes.
So
growth.
your wife funded her annuity with after-tax dollars, and so the growth is what's going to be taxable.
Okay.
So in other words, if they contributed 30 and now it's worth 50, $20,000 would be taxable.
If it had been an IRA where your wife had taken a deduction for the annuity or IRA, then it would be fully taxable. But since she funded the annuity with after-tax dollars, that would be her basis, and the difference between what she funded the annuity with and what it's worth when she takes out, that would be the taxable portion.
Very good.
Okay? All
Thank you so much.
right, thanks for calling.
And I know we're coming up to the news, but I want to say also be careful because Delaware may do withholding from that sale of that house. So you got to make sure you do the Delaware tax return as well this year.
Right, because what they'll do is they want to make sure that if it's taxable on
thought
their
about
end,
that
that
before.
they have already done the withholding upon the sale. So
Yep.
make sure that you do that Delaware return. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. We're going to be back on the other side of the news with your questions.
We are family. I've got all my sisters with me.
Hey, we are family. You're family to us, and EG Tax wants to help you. And if you're getting love letters from the federal or state, if you have returns you haven't filed, whether they're your kids or yours, or you owe a ton of money, we can help and we want to help. So think of us as your family member, and we don't intimidate. We don't say things like, how come you didn't do it? We understand there are life situations that sometimes you end up like a deer in the headlights. You just don't know what to do, and we'll help you. So, we're here to help you. All right, let's
Absolutely.
go back to the phones, and we're kind of talking about getting ready for college. So what we have coming up here is about the American Opportunity Tax Credit and the a lifetime learning credit and things of that nature, state of New York credits. But right now we have Tony that's been hanging. And hey, Tony, how can we help you?
Hi, Esther. How are you guys?
Hello.
Hey.
Hey, Esther, real quick question. My daughter's a recent graduate from a local college. She's planning on continuing her studies. I don't know whether it's going to be within New York or elsewhere, but I'm trying to figure out how we're going to swing this financially. I don't know if she's going to do it on her own, act as independent, or whether it's based on my tax bracket. And I don't know if there's grants available, loans available, etc. But you need to figure this out.
So you're talking about graduate school?
Yes, master's, I believe,
How old is she?
22.
22. So
All
you
right,
can
so-
claim her to the age of 24.
Right.
As long as
So
she's
you
in
can
school.
claim her up to the age of 24. Once she's 24, you can continue to claim her if her income is low enough, and you're still contributing to her supporter. She can't make more than like $3,500. So that's that situation. So she wouldn't qualify. I'm assuming she's already gone to school for 4 years, right?
Correct. And here's a concern. I believe she was entitled to, or not entitled, but she received scholarships. I think she was approved for state funding. I don't know if it's Pell or whatever the federal
TAP
one is.
and Pell.
Right.
Is that only a 4-year program, or is that while she's in
So you fill out your she's going to fill out her FAFSA first, and she's going to get some money, and then she's going to fill out a Grad Plus loan, which is hooked to the FAFSA. So there's loans that she can get, and it also, when she does her FAFSA, it'll let her know if there's any TAP or Pell. Well, she's actually going to have to do her TAP and Pell after she does her FAFSA,
But he's
and
asking,
then Grad
would
Plus.
she get TAP and Pell in graduate school?
I don't think so.
Okay, Tiff was talking about Tap
Well-
and Pell, and I know he specifically asked that.
Right, but she can get Grad Plus loans, and she would fill out her FAFSA too, and the Grad Plus have good loans, and they're subsidized and unsubsidized.
Gotcha. Okay, so it's pretty much loans, grants went away.
Well, not necessarily. I mean,
Check with the school too to see
yeah,
if
I mean,
they.
you ought to first of all kind of complain and say, is there any work study programs that she can get involved in? Is there any, this we can't really afford this? Is there any other solutions? Many times, if they think that you're having some financial problems, that you just don't have that kind of deep pockets, they might help you that way. The other thing is,
There's usually wiggle room if it's a private college. If it's a public college too, there really isn't wiggle room. But if it's a private college, you can say, like Esther said, is there any, programs, any way you could reduce the price?
Really?
Yes.
and have you gone to any college planners yet?
No, I have not.
I will tell you at the next financial, or actually somebody in our group is a college planner, and they really know the ins and outs, and that's what I'd suggest you do.
Rob
Spend
Armour.
a couple $100 and go and talk to a college planner. Then the other thing is, do you have equity in your home?
I'm sorry, say that again?
Do you have home equity? Do you have equity in your home?
Yes.
That's another option that many people want to do, because you can borrow the money for like 4%. And you might want to do a home equity credit line if you don't want to start acquiring gigantic college debt. But depending upon what her master's degree is going to be in, or her doctorate, you'd be surprised how liberal the loans are, because they know that she's going to go into a lucrative profession and be able to pay it off later. But I would suggest you go talk to a college planning specialist. Would you guys agree with that?
Yeah, at Next Financial, they have Jeff, and his phone number is 633-1515.
Jeff Boron.
Okay. Hey, Esther, one last question.
Yeah.
If it makes a difference, I'm hoping she stays local, but she may consider leaving the area, maybe in New York State, or going to another state. If she opts to leave the area, she does her own taxes, and you think that might be...
You can still claim her to the age of 24. It's called a temporary
Well,
absence.
so if you're talking about her being independent,
Correct.
so again, this is something you could talk to the the college planner on, but if independent means that she's on her own, paying her own way, that she's not your dependent anymore, and the college credit that she's going to only get is 20% of the first $10,000. So it's not that much that you would, she could become independent and be on her own and get and qualify for more help, more scholarships. That's something that you'd want to look at for your specific situation, your finances, her finances, with that college specialist.
Okay, very, very good. I think.
All right, thanks a lot. I think it's worthwhile. Mm-hmm. All
Yeah.
right, hey, thanks for calling, Tony.
Because they could run the numbers. You're right, Esther. You make a really good point. Is maybe she would get more aid, more assistance
Right. I mean, if she
she
can
was
be independent and they say, "Oh, this poor sweet baby, we have to help her out," and so Daddy's going to give up what $2,000,
Yeah.
and she's getting $15,000.
And what I was saying is, Dad could still claim her to the age of 24 if she's in a different state. If they decided to make that decision,
Right.
it's called a temporary absence. But maybe that's not the right decision.
right.
Yeah.
I'm Esther Gullius, the tax lady from EG Tax, 8030930. 8030930, star 930 on a cell phone. And I know we have callers coming in, but while we're on this subject of the education credit, let's talk about that. The American Opportunity Tax Credit is for kids that are in the first 4 years of higher education, continuing education, right?
Right.
And the maximum credit is,
2,500 on the federal.
but there's a refundable feature of $1,000, right? So Mom and
Correct.
Dad
So
didn't have any-
1,500 credit, 1,000 refundable.
Right. And so that's a lot of money. And it's not a deduction, it's a credit. So it's money in your pocket. Then on the state of New York, they also have a credit.
Right. It can be up from $200 to $400, and depending if it's more than that, it could go up because you could use it as an itemized deduction.
Right,
And
so even though you're not itemizing on the federal, you're itemizing on the state, and if you use that as an itemized deduction on the state, it might be better than the $400 credit.
correct. Yes.
So that's a lot of money. Now, that's the American Opportunity Tax Credit. But once a kid hits that 4 years that they've used the AOTC, then they move to that secondary credit.
Right, the lifetime learning credit, which switches because the AOTC is per person, the lifetime is per return.
Right.
So if you have 2 kids in college and yourself, you would get if they're in the first 4 years, you would get the 2 AOTC credits and the lifetime for yourself. But once they hit that 4 year, it's only 1 credit, the lifetime learning credit, at the maximum of $2,000.
And so that Tony, who just called, his daughter is going to graduate school, he would slide into the lifetime learning. And of course, New York State only qualifies for undergraduate, and so there is no credit on New York.
Right, so the maximum he would get for his daughter in grad school would be $2,000. So that's why if he can get more because she's independent, he would go for it. All right, let's quickly go to the phones and we'll talk to Kevin in Niagara Falls. Hey, Kev, how can we help you, sir?
Hi, a simple question, I guess. I keep on hearing different answers. So I'm considering retiring at the end of the year, December like 27th to the 29th, somewhere in that area. I have a New York State retirement, so I can get reimbursed or paid for my sick time, vacation time. And I just keep on hearing conflicting things that, it's going to be included in 2019 earnings, but you don't want it to. That's extra money that's going to you. So I guess that was my question.
Well, so it'll be in the year that you receive the income. So if you get it in 19, it's going to be taxable in 19.
Yeah, I wouldn't be getting it in 19.
Well, then it's in the year you receive the money.
That's what I thought. And that's
So then they'll send you another W-2 next year. And then double check and see if you can't put some of that away in your pension plan, because it would be lovely if it wouldn't be taxable if you didn't need it.
Yeah, I can. And that's my plan. I was, I can get a check for up to a certain amount, and whatever's left over should go into my service time.
Well, that's great. And so there you go.
Yeah.
So, well, congratulations. If you're bored, come give us come to our tax school. we'll get you busy.
I took some accounting classes, and I was not very good at, so you wouldn't want me. So.
But it's really, the interesting thing is we really don't do accounting so much, although it helps, as we do law.
Yeah.
It's all about the law. So, and the administration of the law. And that's what makes it so interesting, I think, because the law sometimes is very fluid because you have to go to intent and things of that nature. So our tax school is very interesting. But if you're going to be bored, you can come be bored with us, okay?
Hey, thank you.
Thanks for calling, Kevin. I'm Esther Gulias, the tax lady, 8030930, 8030930, star 930 on a cell phone.
Chris, what were you gonna say?
Yeah, I was going to say, I know Kevin, he's works for the state, so he doesn't have anything to worry about his
New York State.
Yeah, his health insurance, and he's young. But if you're retiring before 65, before you hit the Medicare age, we have Tim in our office who can help you with the marketplace, and maybe COBRA isn't the best course of action for your insurance. There's the essential plan if you can live on your investments, where you could get insurance for as little as $25 a month, and it's one of the best insurances out there. It's unbelievable. He can also help you with Medicare when you do hit that magic age of 65.
Right. So the interesting thing is, talking to your friends about what to do when you're retiring, all this big transition stuff, it's really good to talk to a professional, especially in New York State. With New York State being so liberal with the health insurance, you'd be surprised. COBRA is expensive if you start picking up your own medical insurance and start paying for that, whereas the state of New York is very liberal in their administration of health insurance. And if you can do some planning, you'd be surprised and not have to spend your money. Like, for instance, maybe you want to live off your savings and keep your money in your pension plan so that your income's low. You would qualify for unbelievably low cost, great insurance. And that's another thing that EG Tax can help you with. right?
Yes, sir, ma'am.
Okay. Yes, sir. I'm not sir.
I know.
Mr. Gullius, the tax lady. We're going to take another short break. 8030930, 8030930, star 930 on a cell phone, and you can text us at 3930. Talk to you on the other side.
We are family. I got all my sisters with me. We are
Hey, we are family, and we want you to come join our family. And this is Esther Gullius from EG Tax with Christopher Fabian, Tiffany Fabian, and we're talking about getting ready for college and some of the things that people miss. And one of the things they miss is their student loan interest, right?
Yep.
And a lot of people don't think they can take it anymore.
Up to $2,500 per family per year on your tax return, and it assists on the federal return and New York State, and you can still take it.
And a lot of times people miss it is because they don't get anything in the mail.
Yeah.
And
Now, why is that, Chris?
well, two reasons. One is if it's under $600, places aren't required to mail it. And the second thing is technology. You sign up for paperless statements, and so your information, your 1098, whatever it is, would get emailed to you, or you have to log into your account. So I can't tell you how many people I call Nelnet and what Sally Mae used to be, or what it is now, and get the information right over the phone. And even at $600, $600 at 12% just saved you $72. That's just the federal plus New York State. You're at $80. I'll take $80 any day.
Right. I mean, that pays our fee. Right?
That's right.
I mean, so now it's your tax purpose free. But that's that. So don't forget your student loan interest. Right?
Yes.
It'd be better off if you don't have student loans, but if you do. All right. The other thing is 529 plans. We had a caller at the beginning of the show that talked about a 529 plan. But the 529 plan, all the income grows tax-free provided you use it for higher education. Or actually, it doesn't even have to be higher education for some
Nowadays.
of these things.
Yep.
Right. But it grows tax-free if used for education. On the state of New York, you get to take a deduction for it. It
As
is
long
not
as it's
it's not deductible on the federal, it's deductible on New York State only.
As long as it's a New York 529. You
Right.
can buy an Alaska 529. Doesn't mean your kids have to go to school in Alaska. They just may have a better interest
But
rate.
normally people in New York are going to use a New York
Right,
529.
right.
But the thing is, it's deductible on New York State only. It grows tax-free federal and state, and when you take the money out, it affects that money to pay for education affects the New York State education credit, but not the federal.
Right.
Right? Except
Yes.
for some computations if it's tax-free money.
It-
But so the 529 plan is a great way to save some New York State money only.
Right,
And,
right.
And the growth.
That's right.
All right, and now if you're in a crunch and you say, I haven't, this is senior year for my kid, I said I wasn't going to go get any student loan debt, and I really want to pay for the education, you actually can take money out of your IRA without paying the 10% penalty, right?
Yes. Yep.
So,
The worst, one of the last things I would do.
right, I
Yeah.
mean, but you would save the 10% penalty if you're taking it out for higher education.
Right, and that penalty cannot be avoided if it's from a 401k, but an IRA, yes, thumbs up.
Right. So, this maybe you said to yourself, "Oh, so school's going to cost $10,000. I'm going to take it out of my IRA. You'll have to pay the taxes on it, but not the penalty." And so that's something to think about if you are in a crunch. And the thing is, you can then, pay yourself back.
That's right.
And again, that goes to borrowing the money again. You can actually go to your pension plan, your 401k plan, and borrow the money and pay yourself over a 5-year period. And that would be taxed. And then it's not taxable, and you'd be paying yourself back interest.
Yep, I'm telling you, just stopping and making a plan is so, just asking the right questions and making the right decision,
Yeah, but see, people don't know who to ask. So that's why EG Tax will help you. Or the other thing with kids, many times kids go out of state and they get summer jobs or they get jobs during school and they get a W-2 for working outside of New York State. What happens in that situation?
Well, then they got to file that return in that state as well as the New York return, because New York is going to tax you on that money anyways because you're still a resident of New York even though you're in school in Ohio.
Yeah, but don't
Right.
forget if you pay taxes in another state and you have a tax bill, you can do a 112R for the taxes that you pay to the other state. So
And you'll
make
get a
su-
credit on your
And you'll get a
state.
credit, so make sure you pay attention to that.
Right, and then the other thing I have on my list here is, and getting ready for school, and this would pertain to that other caller we had, apply for scholarships. For a degree candidate, it is tax-free if it's paying for the supplies and the tuition for the school.
You know, you had a really good idea, Esther. Or Chris said this, go to the financial aid office. They actually have a list in the financial aid office of open scholarships that people can apply for. And so the schools know about the scholarships. And so really
And
make
they want
yourself
they
privy.
they want the students, so they obviously want to help the kid to get into school.
Yep, go to scholarships.com, I believe it is, and there's a ton of scholarships out there. I mean, you answer about 50 questions, and they'll tell you what scholarships you can apply to. Some is just entering a paragraph. Some is just saying, I'm interested in this scholarship, and they'll let you know. So
Right, and some of them are maybe $500 here or there, but it's $500 you didn't have to pay for,
exactly.
right?
Yep.
So, and now, what if you get a scholarship and it pays for your tuition? I mean, it pays for your room and board.
Then if it pays for your room and board, that doesn't
That's
matter.
a problem.
That's
Yeah, that's
taxable.
a problem.
That's
but yeah,
taxable.
that's a problem. I was thinking you
Right.
wouldn't get it if it's. Go on, Chris. What were you going to say?
It's a taxable event.
It's a taxable event to the student,
Yes.
right?
Yep. And
So-
and
so if-
actually
in order for a scholarship to be tax-free, it's got to pay for tuition and supplies.
nowadays with the lovely kitty tax, that's considered unearned income.
Right,
And
then, right.
yep, which gets now taxed at not the parents' rate, the trust
but a
rate.
fiduciary
the
rate, which is
fiduciary's
much
rate.
higher.
Yep.
Right. But I heard that they're looking at changing that, so we'll see if that comes down the pike. Okay. You can also make interest payments only on your student loan to keep the loan balance down. So, you know, many times people think the tooth fairy is allowing you to not have to pay that student loan until after the kid graduates. And you can do that if you want, but the principal payment is getting larger and larger because of the accrued interest. And then sometimes the loans don't have interest, but some of them do. But one of the other things you can do as a parent, many times, or a student, is make that interest payment to keep that balance down, which
Yeah.
would then be deductible up to $2,500.
That's right. I have a lot of my parents that do that, and then they deduct the student loan interest, and they can deduct it on their return as long as their name is tied to that student loan. That means that if the loan is defaulted, then the company can go after their assets.
And of course, if it's at all possible, parents try not to sign on as a guarantor to the child's loan, because guess what? You're probably going to end up paying for it.
Yeah.
I mean, because you cannot get out from under it unless you have physical. We've seen several people get out of paying back student loans, but it's because they had a physical problem and they were basically totally and permanently disabled, and otherwise you're stuck paying back that loan. So if you can get out of not paying for your kids, signing as a co-signer on your kid's note, that's really good, because somewhere down the line, if anything happens with your kids, guess who's on the hook?
The
parent.
jig is up.
Yep.
Right? Yep.
Hey, let's go and talk to Larry quick. Hey, Larry, how can we help you?
I have a mortgage question, and the reason that I know you guys don't do mortgages, and that's the reason I'm calling you, because you guys don't have a vested interest answer that you give me.
Right.
I want to pick on your experience. Okay.
Sure.
Okay. Let me tell you what I would like to do, and tell me if it's possible or if it's a bad idea.
All right, do it quick, Larry. We only got 4 minutes.
Someone suggested last night in a conversation that I pay off my mortgage with a home equity line of credit.
Okay.
Got it. The mortgage is $41,000. I've got what the house is worth about $95,000.
Mm-hmm.
What the purpose of that is that so that I can have a free and clear mortgage. I want to give that mortgage to my daughter, and I'm going to pay on the loan. Well, here's where the question comes in for me. What happens if I die?
What do you mean you're going to give the mortgage to your daughter?
Well, I want my daughter to pay off the actual mortgage. What I'm trying to do, on a mortgage, the first 80% of the payments is nothing but interest.
Yeah.
So I've paid all that already, and
Right.
would like my daughter to be able to take advantage of the fact that what's left on the loan is mostly principal, and just pay it off, and then the house would be paid for. But
So that would be like Esther, he was going to gift her the house, right?
So, I mean, yeah, I mean, this is more than a 4-minute conversation, Larry. Because are you putting your daughter on the mortgage? Are you saying you want to take out a new loan, or you just want her to, you want to sign her on the mortgage?
I want my daughter to be able to live, to be able to have my house without somebody being able to take it away from her if I die.
Okay, so I think there's many other things that you can do. First of all, but in the meantime, you're going to live there, right?
I'm still living there.
All right, do you have a will?
Hoping to be living here for a little while.
No, Larry, do you got a will?
I don't, but if that's a problem,
All right, so the first thing I would do is get a will. Secondly, do you have life insurance?
No.
Okay, how old are you?
I'm sorry?
How old are you?
70 next month.
Okay, so life insurance would probably be pretty expensive, but you might be able to get mortgage insurance on your mortgage, that in the event of your death, the mortgage would be paid off. Those are just two thoughts I have. I think that what you're trying to accomplish can be done another way. Why don't you call us on Monday? There's no charge, and we can think about this together and the best thing for you, okay?
Thank you.
632-7886, okay, Larry?
Okay, I don't want to ask a banker.
I know. We're in your corner. We'll be very happy to help you. I'm Esther Golias, the tax lady from EG Tax. If you have any questions during the week, if you want somebody to you want to pick somebody's brain, there's no charge. We're there to help you. Until next week, I'm Esther Golias, the tax lady, with Tiffany Fabian, Christopher Fabian. You can go to our website at egtax.com. If you're interested in tax school, you can sign up there. Any questions, just like Larry, give us a jingle. We want to help you. Have a great week. And this is the last week before the kids go to school, so think about that too. God bless you guys. Bye-bye.